What's up, guys? Today we're going to be talking about implied volatility, as you might have seen it on Robinhood. It's going to be kind of an introduction to it. We're not going to go super deep into it. So we're going to be looking at this 170 strike Apple call that expires on March 15th. As you can see somewhere on your screen here, the implied volatility is 21%. What does that mean? That means that there's an expectation that the underlying stock price is going to move 21% within the next year. That's all implied volatility ever means, is that there's an expected move of that percent within the next year. Now, that move of 21% is actually one standard deviation in both directions. If you want, it'll capture the stock price's move 68.2% of the time. That's all you need to know. It's still possible that it can go higher or lower, but more often than not, it'll stay within that range. Now, how can you use this when you're trading? Well, we have to talk about intrinsic and extrinsic value really quick. An intrinsic value is found in options premiums when they're in the money. There's value given to the premium based on the option being in the money, and the further in the money it is, the more intrinsic value that option has. But as you know, I'm pretty sure, you can trade options even if they're out of the money. There's still premium to them. You go to Robinhood, you can see the little price tag on it, you can buy and sell it. Where does that premium come from? It's not just a price tag for no reason. Like, it's there for a purpose. That value is derived from something, and it's derived from extrinsic value. And what is that? Well, that is two things. It is one, time value. There's value built into the premium because there's days till expiration in which the stock price could swing that option into the money. So there's still time for it to be in the money, and that idea, that value is built into the premium and is part of extrinsic value. And as you know, theta eats away at that. That is what theta is eating away at, is time value. Once it expires, time value goes to zero. The second part of extrinsic value, so let's say we're trading an out of the money option, once you figure out what the time value is, and you don't actually have to figure it out, this is just little thought experiment here. Once you know what the time value is, just chop it off for a second. Just picture this in your head. There's still going to be premium left over. And that premium left over that you're paying for if you're going to buy this option comes from expected volatility, this implied volatility. So if there is a large expected move in the future within the next year, that implied volatility, that little chunk of premium that comes from volatility, is going to be bigger. If there's a smaller expected move, it's going to be smaller. Now, really, you have to think about it in this way. Options prices are not calculated by computers, although they can be calculated by models. The value is determined by supply and demand and how it's being traded on the market. And if there's a lot of people wanting to buy an option, the value is going to go up. If there's not so many, the value is going to go down. If there's more sellers than buyers, then the value is going to go down. So if there's a bunch of people gathering up behind to buy an option, this one delicious, juicy, supple call option, the reason people are doing that is going to be because of expected volatility, implied volatility. However, if you see an implied volatility chart, or the implied volatility here, that 21%, that is actually calculated from the options premium, because mathematicians, or in this case computers, look at the options premium. They can calculate, let's say an out of the money option, they can calculate the time value, and then they can now look at and see how much value is given to that option based on expected volatility. And then that's how they calculate implied volatility. So it actually works that direction. The value of the option doesn't come from implied volatility. Implied volatility comes from the value of the option. Now, how can you use this when you're trading? Well, there's a lot of different ways, but the main way that you're going to use it, and I expect most people use it, is when implied volatility is high, you're going to sell options or enter credit spreads, anything that has credit. You're going to enter that kind of trade, because when implied volatility is high, there's a tendency for it to revert back to the mean. And if it reverts back to the mean, those options prices are going to decrease. And if you sold options to somebody, they're going to be losing money as that implied volatility goes down, and that money is going into your pocket. However, if you were just holding a call option and implied volatility went down, that part of extrinsic value would start evaporating, and you would be losing money. Now, if implied volatility is low, it has a tendency to revert back to the mean. And if it reverts back to the mean, that means implied volatility is going up, and you're going to be getting value built back into that option. More and more extrinsic value is going to start clumping together onto your premium, and you're going to be making money, even if the stock price doesn't move. So if implied volatility is high, you want to sell. If it's low, you want to buy. How do you know if it's low or high? Well, you have to look at the stock's implied volatility. You can't go 21% is high, because that 21% could be low for another stock's options. So what you can do is go to the link I sent. I think it's marketchameleon.com. There's charts that you can see. You can kind of eyeball it there. You kind of eyeball it there to see if it's above or below the mean. And that's just a kind of general idea. You can see, is it high or low? Another way to do it is through IV rank. And I'm not going to go exactly how that's determined right now, But you can actually see that on Tastyworks. If you get a Tasty Trade account, that's what I use. I don't use Tastyworks to trade. I just use it to see their IV rank. In general, though, it's just easiest to eyeball the chart, and you can kind of just see if it's high or low. If there's a better way to do that, somebody let me know. I, in general, just use Tastyworks IV rank. And again, it's free to set up an account with them. As I mentioned, if implied volatility goes up, a stock options premium is going to increase. Now, you might want to know how much it's going to increase by. And that's what Vega is. Vega, in the Greeks, as you can see in Robinhood here, Vega shows how much the options premium is going to increase or decrease based on 1 percentage point move of implied volatility. And remember, Vega is multiplied by 100. So if it says, like 11 cents, that means $11. So implied volatility low, debit. Implied volatility high, credit. Okay, if you guys have any questions about that, definitely let me know in the comments. Also, you can see on my channel in my community tab, I am going to be doing a series on how to build small accounts. Now, if you guys have anything you want to specifically learn from that whole journey I'm about to go on with you guys, definitely comment about that down below, because I want you guys to get as much value from it as possible. I'll probably be starting on the 28th just to give myself enough time to figure out the exact format of how I want to do it, and then also give you guys time to give me feedback about what you want to learn as I'm doing it. What do you want to get out of that whole series? So have a good day. Hope you learned something from this. I'll see you guys later. Bye-bye.